Okay, just like we've been making decisions about our products and how much of each product to produce, etc., we can actually use some of our same skills to also analyze the profitability of customers. We saw in a past chapter how we could go about using activity-based costing, coming up with the cost to handle each specific customer. We can actually use that information to analyze the profitability of those customers and to aid us in deciding whether or not to continue servicing those customers. So we can drop customers, but we can also add customers. So we can use that information to do that. We could also use the same type of skill set to analyze whether or not we want to continue operating a plant or a division of our company, or possibly adding one. All right, so let's take a look at that here in this specific section. All right, so we would need to look at the relevant revenues and relevant costs and analyze the information. So when the cost object is a customer, managers must decide about adding or dropping the customer. And the decision rule is, does adding or dropping the customer add operating income to the firm? Many times you guys may, on its face, look at the bottom line and say, you know, they've got a negative operating income, we need to get rid of them. But in all reality, what you have to understand is that many of the overlying costs have been allocated amongst and distributed amongst multiple customers. And in essence, they are actually helping to cover those. And if you drop that customer, your other customers have to take on that extra load if there is not a way for you to eliminate those costs. So for example, corporate administration costs and expenses. If you get rid of a division, if you cannot get rid of some corporate administration at the same time that eliminates what was being allocated dollar-wise to that division, then you are not actually improving the bottom line. All right, so again, you guys have got to work with management on gathering the information and displaying it to them with all the bells and whistles so that they can make a good decision. All right, so if we add operating income when we're looking at adding or dropping, then yes, we should add, or yes, we should drop, depending on which one of those questions we're trying to answer. Again, it's all about operating income. If it's increasing, it is good for the company. If, on the other hand, when we calculate using all the relevant costs and relevant revenues, what's going to happen if we add or if we drop a particular customer, and the operating income goes down, then no, we do not, because again, there is something in that underlying information to be said. We are actually, even though on its face it doesn't look like it's doing us any good, in all reality it actually is. So make sure you gather all the information correctly, utilize relevant revenues, utilize relevant costs, ignore things that are not going to change amongst the alternative, ignore past sunk cost, and analyze the information properly. Again, we can look at existing customers here, keep or don't keep, and we can also be evaluating our potential new customers. Do we want to add them or do we not want to add them? We can use this skill set to do that. The decision is definitely based on incremental income of the customer, not just on how much revenue a customer generates. Incremental income, incremental revenues minus incremental cost. All right, not just looking at the revenue dollars. We have got to understand that it takes a lot in order for us to service our customers. If it's products, it's not just cost of goods sold. It's the material handling. It's the shipping and data entry. It is marketing people. It is outside salespeople's visits to those customers. All those things cost us money, okay? So don't just look at the revenue dollars. You've got to think of those underlying items. All right, so here we've got a company. It's Allied West, and they are a sales office of Allied Furniture. And Allied Furniture is a wholesaler of furniture, and they supply furniture to 3 separate local retail customers. Okay, so they're shipping it to the retailers, and the retailers are the one who sells it to the end consumers. All right, we've got their expected revenues here, Vogel, Brenner, and Whisk. You can see that we've got 500 grand, 300 grand, and 400 grand. That's what we have as expected sales. You then see their cost of goods sold for each one of those particular customers. But then you see the underlying amounts that have been allocated to them by the accountant based on activity-based costing. All right, so you can see that we've got furniture handling labor, $41,000, $18,000, and $33,000. The furniture handling labor costs have been allocated based on the number of units that is expected to be sold to those customers. Again, think back, we're using historical information. What do we think they're going to buy next year? And coming up with some numbers of what we expect to ship them. So based on that information, we can come up with a dollar amount for their respective share of furniture handling labor. All right, next line says furniture handling equipment cost written off as depreciation. All right, so for these specific ones, we are assuming that the furniture handling equipment in the area and its related depreciation cost go with those individual customers. So we have equipment that's sitting in a specific area of the warehouse. Vogel has X number of square feet, Brenner has X number of square feet, and Whisk has X number of square feet. In those square footage amounts, each area has its own equipment. For example, a fork truck and something else. All right, so their respective equipment is showing up underneath them. We've got the rent. Based on their square footage, they are getting so much of the warehouse rent allocated to them. Their marketing cost, we are tracking the number of sales visits that our salespeople or marketing people have to make to them. And based on those number of visits, we've allocated the marketing support to them. So you can see Vogel's got 11, Brenner's got 9, and Whisk has 10. Sales order costs are batch delivery costs, and based on the number of sales orders, we've allocated amounts for sales orders. Delivery processing costs are also batch level, and based on the number of shipments made to each one of these customers, we are putting the sales order and delivery processing into one group, but the delivery processing is based on the number of deliveries. All right, so 13, 7, and 12 cover those 2 allocations all together. Regarding fixed general admin cost, these are being allocated to the customers based on the ratio of customer revenues. So 500,000 plus 300,000 plus 400,000 equals 1.2 million. We've got a total general admin of 48,000, and each customer is going to get their allocation of their respective percentage of total revenues. And then our allocated corporate office cost, those are being allocated to the sales office on the basis of the budgeted cost of each sales office. and then they're being allocated to customers on the basis of their revenues. So we're using revenues under two underlying components. All right, so let's look at the operating income. Vogel's got 9 down here at the bottom. Brenner has 16,000. Notice that these two are both lovely positive numbers. But then looking at Whisk, we are not generating any operating income. We are actually eating into it. Negative $32,000. Do we want to eliminate Whisk? Okay, on its face, 32 in the hole. Yeah, it looks like we want to get rid of them. We want to not be dealing with them anymore, or we need to come up with another way to make that go to a positive number. Increase our revenues. Somehow reduce our number of orders, processing and delivery cost. Could we be more efficient in our furniture handling? Maybe the number of square footage, maybe we can somehow find a way to better utilize our space. What kinds of things can we do to do that? Or do we want to just analyze getting rid of them? All right, so let's take and go to the next step. Should we drop Whisk or not? And then in a second, we'll also look at another column because we could also look at adding a customer. So let's first look at scenario 1. So just pay attention to this first column right here. All right. In analyzing dropping Whisk, what we have to do is go backwards. If we subtracted the revenues, what would happen? If we saved in the cost and expenses, what would happen? All right, so notice that our revenues are being subtracted, but then our cost and expenses are in essence being added back. So we're trying to find what would happen or what the effect would be on our operating income. Would we have a positive result or would we have a negative result by dropping Whisk? All right, so if we dropped Whisk, we would no longer have that cost of goods sold number. Again, we're pulling some of the information from this column over to the next page. But I want you to notice, we're not pulling everything because, again, there are certain numbers in this column right here that are being allocated to Whisk. All right, furniture handling labor, we would save that. So notice cost of goods sold plus furniture handling labor are being added back. But the furniture handling equipment cost that was showing up on the prior slide, I believe is $9,000, is not being added back. It's a sunk cost. We cannot go back in time in a time machine and not buy that piece of equipment. Okay, so it is sunk. We are not adding it back. Regarding the rent, the portion of the rent, that total check that has to be written every month for our entire facility is not going to change among the alternatives. Okay, so it's irrelevant. We're not adding it back, so don't make that mistake on your homework or on a test. Our marketing support, we're not going to be sending somebody out for that. We can take that off. Somebody might be losing their job or their hours may be cut back. Sales order and delivery processing, yes, we can save on that as well. Notice it's being added back. Again, somebody may be losing their job in order to make this happen. Our general admin and our corporate office costs, those two, recall that we just said they're being allocated based on our calculations. Under our scenario and the fact pattern given, those two cannot be reduced even if we eliminate Whisk as a customer. All right, so with that being the case, they are not relevant. They have to still continue to be covered. They will have to be covered by the other customers, and that is why we're not adding them back here. All right, so revenues would go down by $400,000. Total cost would go down by $385,000. And the net effect of those two right there means that revenues dropping that $400,000 and eliminating $385,000 of cost does not help us any, because at least we had $15,000 extra coming from that $400,000 in revenues that was used to cover some of those other items. Right? So we would not want to actually drop WISC. They are actually helping. Right? Could we find some better ways to deal with them? Probably so. All right, let's look at the second column over here. We could again use the same type of skill set in defining whether or not we want to add another customer. All right, so there's another customer by the name of Laurel. They have a customer profile a lot like WISC. The company predicts that we could sell them $400,000 worth of revenues, and we would need to spend $9,000 to get our furniture handling equipment. Notice that our labor is expected to be the same as WISC. Our cost of goods sold is expected to be the same as WISC. Rent, we don't need to add any more square footage in order to deal with them. The rent is already being covered by our 3 customers. So notice that there's nothing here showing as a cost for rent. It's not going to change. We do expect to have marketing support and sales order and delivery processing, but we do not expect to have to add any general administration or corporate office costs and expenses in order to support this addition of a customer. Okay, and what is already being incurred is being covered by the other 3. Okay, so that's why looking at this, we are not adding them as additional costs, just like the rent. We're not having to cover them in our analysis. They are irrelevant. They are not changing with this scenario and whether or not we want to add Laurel. All right, so look at our numbers, $400,000 in revenues minus total cost of $394,000 equals positive $6,000 in operating income. Yes, we absolutely would want to add this customer. Again, this is another prime example of why I wish we had management students taking not only your cost accounting class, but your advanced managerial. So work with those management folks in detail and spell it out for them, and maybe even give them an executive summary report stating why rent is 0, why general admin is 0, and why corporate office costs are 0. We could use this for whether or not to add a branch or division, or to discontinue a branch or division or some type of segment of our company. All right, so again, we're looking at the bottom line. Is operating income going up? If so, do it. If not, do not do it. All right, so again, we're still looking at incremental income, not just at the top line. We're not just looking at revenues. So in regards to our company that we've been looking at, we've got Allied West. We need to evaluate their performance. And here in this first column is what would happen if we closed Allied West. And Allied West is what we were just looking at that had the 3 specific customers. If we eliminated Allied West, revenues would decrease by $1.2 million. We would save all of the cost of goods sold. We would save all of the furniture handling labor, and people would lose their jobs. Our furniture handling equipment costs, we are not adding anything back here. The furniture that was purchased in the past is a sunk cost, and in our scenario, there is no cash value in selling off that property, plant, and equipment. If there was, we could recoup some cash and need to add that here. Rent, we will save our rent, $36,000. We will save marketing support. We will save on sales order and delivery processing. Again, marketing people, sales and data entry people, and delivery people, losing those jobs. We would be able to save in our particular scenario given to us based on the fact pattern, general administration cost to the tune of $48,000 by eliminating some of that administration and saving $48,000 of it. Let me see what the original number was, if it's on here. So we're going to save all of the general admin. However, when you look at corporate office costs, originally $24,000 of the corporate office costs were being allocated to Allied West, but that is still going to have to be covered by the other sections or divisions of the company, even if we eliminate West. All right, so notice it's zero. So total cost, or the total savings in cost, is $1,158,000. If we net that against the revenues, we get a negative of $42,000. Therefore, we would not want to eliminate West. They are contributing. All right, so we would not want to do that. Looking at the next one, would we want to open another division? We've got Allied South. We expect for their revenues to be about the same as Allied West. We expect their cost of goods sold, their furniture handling labor, their rent, their marketing support, their sales order and delivery processing, and even the general administration that would be required to handle them would be about the same as West. And then we would have to make purchases of furniture handling equipment for $25,000 in order for them to operate. Corporate office costs would not increase if we open Allied South. They're not getting an allocation of it. So would it be to our benefit to open Allied South? Netting out revenues, positive 1.2, minus the total cost that we expect to incur to do it, 1.183 shows us a positive effect on operating income. So yes, we would want to open Allied South. I do want to mention here that we do have to be careful in these kinds of analysis. If there happen to be some other type of use of the Allied West facility, could we generate some other type of income? We would have to analyze that, looking at it like an opportunity cost and adding that in and deciding whether or not we wanted to eliminate West and start doing something else with West facility. So do be careful in analyzing your information. I did mention too that in our scenarios we're saying that our equipment has no disposal value, but what if it did? We would need to add back some of that cash that could be recouped.